let's jump right into it. I've got some great stuff for you. By the way, I don't have anything to sell you today. I'm sorry, I don't have anything to sell. So you can put your wallets away and your purses away. Yeah, I just got nothing to sell you. So all I have is good free education for you. And at the end, I'm actually giving away a free mini course. So you get that, but you don't have to pay for it. So just good free stuff for you today. All right, so let's get started. Reed already introduced me a little bit, but I've got this slide here. So just a couple extra little things. I got done reading a book called Trend Trading for Dummies, part of the Dummies series. I got numerous Reader's Choice Awards, featured in various books, worked with a lot of different brokers and exchanges, in writing for them, training for them, did some software stuff with Metastock, I did a plugin for them. So yeah, we won't go through all that again. Reed already did a good introduction for me. Important disclaimer though, got to make the most important people in our lives happy. And of course, I think it goes without saying that we all know that the most important person in our lives, the most dear, warm-hearted, lovely, kind, caring, unselfish person in all of our lives is our tender-hearted lawyer. And so we got to make him happy, so that's what we're going to do. But seriously, this is not only for legal reasons, although it is for that, but it's also really where your education begins. And sometimes we see these disclaimers so often that we tend to just not look at them or think about them, and that's a mistake. Because this stuff really is important. These legal statements came out of a lot of hurt, and that's why we're required to give them now, is because these things really, really, really are important. This is where your financial education begins. And so please, please, please be very aware that trading is not suitable for all people. It really isn't. It's a profession. It's not a get-rich-quick scheme. It takes time, like any other real profession. It takes education and study and to be a good student. So, and to get some experience under your belt before you're going to, get good at it. So understand that and come in with your eyes wide open. Understand that trading is always risky. The markets are inherently risky. That's why they used to call it, we call it trading now or investing. But it used to always be called speculation back in the old days. And I kind of like that term because it reminds us of the risk in the markets. Also, some markets are leveraged, so if you're trading leveraged markets, be very, very careful with that. Know that it's a two-edged sword. Really a good idea to talk to your broker and ask them what your maximum risk exposure is based on what you trade and what margins made available to you. Please, dear Lord, only use funds you can afford to lose. We call that discretionary money. Do not trade with money that you need to make house payments, car payments, kids' college education, your retirement, that sort of thing. All information in this presentation is for educational purposes only. I'm not going to be giving any specific buy or sell advice. Use this information at your own risk. It's for general purposes only, and we assume no responsibility or liabilities for any errors or omissions. Okay. He's not here right now, but I'm sure that wherever my lawyer is, probably out on the yacht that I bought him, he's probably smiling. So that means we can move on. All right, a little bit about you guys. I'm very interested to know, and I can customize the presentation a little bit today based on your answer to this question. What are your most common trading problems, struggles, or frustrations? If you would, just go ahead and type that into the questions box, and I'm actually going to pull that module out here and see what kind of answers we get. The reason I say I can customize the presentation, I can't change the slides, obviously, but what I can do is, based on your answers here, I can focus on the things that are your biggest problems. And so that means that I'll be spending some time on certain slides, and then other slides I might even just skip if they really don't pertain to your interests today. And the slides that do pertain to your interests, I'll spend more time on them. Okay, so let's see. We've got managing losses. Okay, very good one. How to filter through all the information. Yeah, that's a bit. Oh, I hear that one a lot. Consistency. Again, another one. Consistency of good trades. Good. Not knowing when to sell a stock. Okay, great. Emotional control, says John. Right, very important. Chris, efficiently finding good setups. Okay. Yuri, money management. Good one. How to prevent wins from turning to losses. Okay. When or where to get out of a trade. Leveraging my money to find good opportunities. Choppy days. Determining market trend reversals. Sideways. Daily ranges. Getting in and out. Getting out of losing option trades. All right. Time due to full-time work. All right. Fear due to fear of loss. Not practicing to above reasons. Okay. I'm long when the market tanks and short when the market goes up. Can't control risk. Yeah, that's another very common one. Indecision. Not knowing how to cut losing trades loose. Okay. Finding good stock screens. Indecision. Okay. So we're getting a lot of similar ones here, and they're ones that I hear a lot of. Mohammed just add one, risk management. Good. So these are good ones. These are important ones. You guys are right on target with identifying very, very important issues. And the good news is there's answers to all of them. These problems can be overcome. And I've done a lot of surveys, really, literally with tens of thousands of traders over the years, asking them this question along with some others. Here are the most common answers that I got, and see if these sound familiar to you. So the most common answers to this question were these. And by the way, these answers are not in any particular order, and I kind of grouped them together by theme. So one very common answer was people would say, well, I enter the market, and then right after I get in, the market turns around and stops me out. Then, right after I get stopped out, the market turns back in the original direction of my trade. That sound familiar to anybody? That one I get all the time. Yeah, okay. So Craig's like, yep. And yeah, me too. Okay, good. So, well, not good, but I could definitely help you with that. In fact, I'm pretty much an expert on that one. Another one that a lot of you have already mentioned is getting out of big moves too soon, and so not making the huge profits. And yeah, there's, sometimes the markets make big moves, and we want to take as much advantage of that as we can and make the most money we can so that our risk-reward ratio is good, making sure that the reward part of that ratio is as big as is reasonable and possible. Another one, getting stopped out too often. Anybody have that problem of getting stopped out a lot? Actually, some of you already did mention that, yes. Not knowing the best place to exit the market. Again, a lot of you already mentioned that one. Trading a trend that doesn't follow through. Again, several of you mentioned that. Not knowing, which side to go. You go long, and then the market goes down. You take a short, and then the market goes up. And sometimes you might even identify a trend, but guess what? Then all of a sudden, as soon as there's an old joke in Wall Street, by the way, how do you determine, it's kind of a riddle, but it's really a joke, how do you know when a trend is going to end? Anybody know the answer to that question? How do you know when the trend is going to end? And the answer is right after you get in. So, doesn't it seem like that sometimes, though? Yeah. Oh, some of you actually got it. Oh, okay, good. Yeah. Wow. All right. Yeah, about 4 of you actually answered that one correctly. But yeah, I mean, that's a common experience, isn't it? So what I've done is today we're going to be addressing these issues, and obviously we don't have too much time, but I'm going to share with you how I address these issues. The good news is all these things can be overcome and have been overcome already by others. So the answers are there. They're available to you. I wrote an article one time, I think it was, I forget who it was for now. But anyway, I've written so many articles and so forth, sometimes I forget which companies I did them for. But the title of the article was Trading, or Good Trading is unnatural. Good trading is unnatural. And the basic idea was, and I actually explained why that is, the reason for that, and why it almost has to be. But the bottom line was, it's not instinctual. The way the markets move is the exact opposite of how human people behave. And there's been a lot of studies been done, of course, on behavioral psychology when it comes to finance. And so it's kind of based on that. But it has to be that way. It actually has to be that way in order for the markets to work. It's kind of interesting. And if you want to rate me, I can send you that article. Anyway, so here's what I do. Here's what I do. My trading methodology is all about one thing. And that one thing is to measure what I call the energies in the market. That's all I do all day long, okay? Measuring the energies in the market. Now, somebody said one of their problems was, well, basically information overwhelm. There's too much information, not knowing which information is important, which isn't, being overloaded. And boy, that's true. And again, that's a very common one too, because it seems like there's no end to the amount of information you can consider when trading and when investing. So you can't consider it all. There's just too much. And so what professionals do is we claim our territory. We go in and we say, okay, there's way too much information to process all of it, and a lot of it doesn't really matter anyway. So we go in and we say, okay, I'm going to claim this. This is going to be my game. I'm going to trade this part of the market, this piece of the information, and I'm going to get an edge in that area, and I'm going to become an expert at this niche within the overall market. And we all do that. We all do that. Because you have to keep it simple. When I went to Chicago, got an appointment or an apartment out there, and I was working with the floor trader at the CME, he was my mentor, I was amazed because I'd already been a trader way before that. My dad was my first teacher. He was a stock trader, and so I'd already been trading for a while. But I was amazed at what those guys did. They were making truckloads of money. I'm talking 4 or 5 figures a day. And what they did was super simple. And I used to think, you know, to increase your probabilities of winning and all that, you've got to keep adding more stuff. The more indicators or the more information I had, I would increase the probability of winning. And what I found was it was exactly the opposite. My stuff was too complicated, and I needed to pare it down. I needed to simplify, and so that my mind could be clear, because as somebody else put in there too, it's the psychological issues that are challenging for so many people, and really for all of us it is. And you got to manage that. You can't really manage the market. The market's going to do what it's going to do, but so all you can do is manage yourself. And to do that, you've got to keep things manageable, meaning just a small amount of information so you don't feel overwhelmed. You're always clear, and you always have clarity in what you're doing. That's why I call my approach to trading a methodology, because I'm very methodical about what I do. I'm very rule-based. I'm always perfectly clear. I never have a sense of overwhelm or fear or confusion. I'm always very confident because of the clarity that I bring to my trading. So all I do is one thing: measure the energies of the market. Now, what are my energies? That actually kind of goes back to what John was talking about. It's about the energy of the market is the flow of money in the market, the buying, the selling. Now, I don't give a rat's left patootie about the bids and the asks. The days of the Sos bandits, you know, that's kind of gone. There's still, you know, tape reading is very valuable, but what I'm interested in is the commitment of the money, the actual buying, the actual selling. It's just like the old saying, you know, actions speak louder than words. Quite often the bids and the asks are just the words. In fact, people game the level 2. I've sat next to a friend of mine who trades 100 lots on the E-minis, and he sits there and he puts in bids and asks, and then as he comes close to getting filled, he pulls them. Why? Because he's gaming the market. He has no intention of having those orders filled. He's actually trying to be deceptive. So I learned from that and from a lot of other people too that no, today we got to really just look at where the commitment of the money is, and primarily from the professionals, just like John was talking about. So when you talk about the energy, that's what we're looking at. The actual buying, the actual selling, no theory. I'm looking for where the money is, especially the big money. So there's 5 energies I look for. I've simplified my trading methodology down to 5 things, and this is pretty much all I look for. I'm a technical analyst. I look at the charts because the charts tell you what is, what's really happening, not what should happen. You know, you can look at fundamental analysis. You can look at, you know, the recommendations of analysts and all this kind of stuff, where what's logical. But you know what? Sometimes good news comes out and the market tanks. Sometimes bad news comes out and the market goes up. Market doesn't always work logically. In fact, you know, again, John mentioned Dow theory, and Dow theory is still very valuable. And one of the things it talks about is the discounting of the market, which means basically it goes back to the phrase buy the rumor and sell the news. By the time the news comes out, by the time things are known, it's too late. The deal is done, the game is over, the pros are done. So this is why it's speculation. They come in before the facts are out, before there's certainty. Trading is all about coming in when things are not certain and getting out when they are. Because by the time everybody has the news and it's all clear, then boom, the game's over. Okay? So anyway, what I look at is what the market's actually doing, not what it's supposed to do. So the first energy is trend, simply direction up or down. Now that's valuable, but trend, by the way, none of these energies by themselves are worth anything. It's the confluence of energies, as we'll talk about in a minute. So trend is the first thing, because I have to make my first decision is which side of the market do I want to be on? Do I want to be long or short? Okay, trend, however, is a lagging indication. It only tells you what the market's been doing up to this snapshot in time, gives you 0 indication of what it will be doing in the future. So then we got to go to energy number 2. And energy number 2 is momentum. Now, when I learned about momentum, it dramatically changed my trading, because momentum is a potentially leading indicator, unlike trend. And that's what you need. You need an edge in trading, and momentum is a huge edge. Now, why do I say momentum is a potentially leading indicator? It is by its nature, by its very nature. If you think about momentum, what comes to mind? Something like a train going down the tracks, okay? And that train has a lot of momentum behind it. You could pull the brake on that train, and it's not going to stop. It'll start slowing down. It will eventually stop, but it's not going to stop on a dime. In fact, I actually saw a case study on television the other day where they showed a train with, I think it was 30 cars going 60 miles an hour. That was it. They would take that train, once they put the brakes on, it would take that train a mile to stop. So momentum by its nature, once you get it going, it's a leading indicator. You know that things are going to keep going. Now, in trading, that's super important, because when we buy, it's just like we talked about, right? The trend is your friend until the end. So when is that end going to be? It's very important for us to know. We can't know with certainty, but here's what we do want to know. When I get in, if I'm buying, I want that market to at least make one more higher high after I get in. Because if it does that, then I can manage my position. I can use a trailing stop. I can take some profits into that next resistance level. I can cover myself so that I don't take a loss. And that's so powerful. If I can just take that, what happened to my screen here? Oh, there we go, I see. Okay. All right, so if I can just make sure that, or have a high probability that the market's going to make another higher high after I get in, then that's amazing. That's huge, and that's what momentum does for you. So the third energy then is cycles. So now if we have a market that's going up and there's momentum behind it, the third question is, when do I enter the trade? Because this is where people get messed up. All right, so let me do a quick little illustration. And by the way, I'm going to give you a little warning ahead of time that I am one of the most notoriously horrible artists in the world. And then you put me trying to draw with a mouse, and it's even worse. Okay, so here let's say we've got a trend that's going up, higher highs, higher lows. Okay, and the market comes down, and we want to buy there. Okay, so we buy, and then the market makes another high, but then it goes back down, takes out this low. This is what we talk about, where you get in, market fills you, then you get stopped out, and then the market goes back in the original direction of your trade. My mentor in Chicago, he used to say, retailers are often right, but at the wrong time, and that's what he meant. So the key is when, with cycles. How do you know to buy here or whether to buy here? That is a timing issue. So many people, they just trade the right-hand axis. A chart is a two-dimensional object, right? We've got price, we've got time. That's it. 2 dimensions. And so many people leave out, they don't have any kind of timing indicator, and so therefore they're trading only 50% of the two-dimensional object. Well, how can you possibly have or create a probability scenario if you are only trading with 50% of the information? You can't. You can't. So that is a key thing, and actually next week I'm doing a webinar, another webinar, also a free one by the way, on timing, how to time your entries. And I'm going to be giving away my timing indicator, absolutely free, to everybody who comes. You're welcome to come to that. I'll give you information at the end about how to get on that webinar. And that is, again, absolutely powerful so that you don't keep getting stopped out so often. The fourth energy is support resistance, which is really a blockage of the first 3 energies. We want to buy off support, sell off resistance, and we also use them for profit targets. And then the 5th energy is what I call the fractal energy, which is just using multiple time frames of the same chart, okay, or the same instrument, the same market. So if I'm trading off a daily chart, then I would also look at a weekly chart, and that weekly chart I would call my fractal energy. If I'm doing intraday trading, then if I'm doing, say, a 5-minute chart, trading off that, I would look at a 15-minute chart, and that 15-minute chart I would call my fractal energy. So then we use instruments for measuring these energies. Why? Because, again, I don't want to just look at a chart and with my discretion subjectively say, oh, the market's moving up, so the trend is up. No. We have instruments, or as they're more commonly called, indicators, that give us an exact value for each one of these energies. So again, it's rule-based. So we use a moving average for trends, for momentum, of course, a momentum indicator. For cycles, we have an oscillator I'll give you next week. Support resistance, previous cycle highs and lows, wave highs and lows, floor trader pivots, Fibonacci levels. For fractals, I use a chart usually that's 3 times that of the setup chart. The whole reason for doing this, why are we looking at these 5 energies? The whole reason for doing it is to determine a probability scenario. Again, trading is always risky, but the difference between trading and gambling is in trading, with a successful methodology, we can put the odds on our side, and we do that with a methodology. So how do we do it with my methodology? And there's many different successful methodologies, by the way. There's certainly not just one. Many ways to determine a probability scenario. But here's the one that I settled on. At each potential entry point, I simply ask myself how many of those 5 energies are aligned, all saying buy or all saying sell. I give each setup a score of 1 to 5 based on, of course, how many of those energies are aligned. Obviously, the higher the score, the higher I consider the probability. I liken this to taking each trade to court. And what I mean by that is I need 5 independent witnesses to establish a preponderance of the evidence. Now, the operative word there is independent. And the indicators are not the key. The indicators, they just do what they promise. They indicate. Okay, hey, if indicators made us money, we would call them money makers. So indicators are just, frankly, mathematical formulas. Let's just call them what they literally are. You put some numbers in one end, the mathematical formula crunches those numbers, and it spews out a value out the other end. Now, I use it in this way. That value is the value of that energy it measures, so that I have an objective measurement. I don't have to, rely on my own judgment. So everybody who trades my method, well, we see everything exactly the same way. Everything is rule-based. Now, the operative word, as I said, though, is independent. For example, if you were to put 5 trend indicators on a chart, that would be useless, because it's not having 5 indicators. Those 5 indicators are all measuring the same energy, so you would still only have a 1 out of 5 trend. And trend, trading a 1 out of 5 probability scenario, that's silly. No way. So that's useless. So what we have to do is, each one of these indicators by themselves is useless. But when we put them all together, then they work. Why? Because they are independent. Each one is uncorrelated to the other 4. In other words, momentum is uncorrelated to trend, and trend is uncorrelated to support resistance, and support resistance uncorrelated to cycles, and cycles uncorrelated to the fractal energy. Each one of these is uncorrelated to the other 4. Therefore, when all 5 independent witnesses say buy or sell, now you have a high probability scenario. And with the cycle indicator that I use, it finds cycle highs and lows with amazing precision, so you rarely will ever get stopped out. It's just incredible how accurate it is. So that's what I do all day long. It's just 1, 2, 3, 4, 5. All right, so let's look at a few charts here, and I'll just kind of, let me bring up my little, we'll finish up here just showing you some slides and showing you how it works with some visuals. So energy number 1 is trend, as I said. The indicator I use for that is simply the 50-period simple moving average. That's an intermediate trend indicator. See, you can't use short-term moving averages for trend. Can't do it. It's illegal. Well, it just doesn't make any sense etymologically, because the word trend, as defined by Webster's dictionary, is to extend in a general direction. Extend in a general direction. So it's a long term. And there's a practical application to that beyond the etymology, and that is we want to trade long-term moves because then we get a good risk-reward ratio. We want to make more money than we're risking every time. So you've got to use a long-term indicator as the bottom line for trends. So that's why we use the 50-period simple moving average. Also, we use it because it's one of the most commonly used moving averages, that and the 200 SMA. All right, does it work by itself? Absolutely not. Completely useless by itself. But when combined with the others, it's a powerful part of the program. So, let's just show you one more thing here with trend that is a big mistake a lot of people make. So a lot of people would say, okay, here's a higher low and a higher high, therefore this is an uptrend. That is literally wrong, because again, that is not the extended general direction of the market. That's a short-term move. The extended general direction of the market is down, and the 50 MA shows that very well. Now, it just shows general direction, doesn't help you with timing or any of that stuff. That's where we have to use other things. By the way, this is an interesting, the free course I'm going to give you guys today will go into this, but here is a great example of how to trade against the retailers. Retail is kind of equivalent of losers, actually, and I don't mean that in a derogatory manner. I mean it in a literal manner, people who lose money trading. But a lot of people would look at this, they say, oh, this is a reverse head and shoulders, and I'm going to go long here. And they'd say there's the left shoulder, there's the head, there's the right shoulder. That is not a head and shoulders. This is one of the big differences between professionals and amateurs. Amateurs look at something like that and they mistakenly think that's a reverse head and shoulders because they've seen it in a book somewhere. Now, that does not even meet the definition of a reverse head and shoulders. Also, they would say, oh, it's good to go along the first higher low. Sometimes, but a price pattern like that, again, does not give you a probability scenario. This is why we don't rely on any one thing, including a price pattern. We incorporate price patterns, but we have to look at other things as well. And what we're seeing here is the overall direction is down. So we're looking to trade against the retailers making this mistake. And we could, so we're only looking for shorts. Could short there, could short there. And we know that we're trading against the amateurs, which gives us even a higher probability. Okay, now let's go on and go to energy number 2, momentum. So here we have a higher low, higher high, higher low, higher high, higher low. Now, if we bought this higher low, that would work out fine. We'd get another higher high. If we bought this higher low, we would not be so fine. And yet, the 50 MA is moving up, and we've got a trending pattern on price. So, question, how would you know to buy this higher low, that'd be safe, but not this one? Well, with the information on the chart, you would not. So, why? Because you're blind to momentum. Remember, momentum is the potentially leading indicator, giving us an indication of what will happen after we get in. So, let's pull the curtain up here from below. This is our momentum indicator. Price makes a higher high and a higher low, so does the momentum indicator. Okay, great. That means at this point in time, see, momentum is above 0. Therefore, it's bullish. Therefore, this trend is still strong. Higher high on price, ooh, little bit of a lower high on momentum. That's your first concern. That's your first little warning flag. Then in the next higher low, momentum takes a much lower low and zeroes out. That means there's no strength now behind this trend. See, there's two types of trends, strong trends and weak trends. We only buy the strong ones. When the trend does not have strength behind it, which is what momentum tells you, then you either want to stay out and not take that trade, or again, this is a beautiful pattern for amateurs to trade. They will trade that, and so we would actually fade the trade, knowing that we're trading on the opposite side of the losers. And you have several opportunities. That would be the most aggressive short. That would be the next most aggressive, and this would be the conservative entry. Now we're under the 50 MA. We've got a beautiful candlestick pattern, and momentum is actually negative. Cycles have to do with the respiration of the market. Markets don't go straight up or straight down. They wiggle up and they wiggle down. Why? Because life is wiggly. People are wiggly. People are not linear in the way that we behave. Again, I got a whole webinar on that about trading psychology and how the psychology of people is reflected in the charts of stocks and other markets. But anyway, so markets wiggle up, wiggle down, and this is just kind of a basic version of the cycle indicator I'll give you next week. But timing is the key. And W.D. Gann even said, of the two things, price and time, of the two dimensions, time is actually more important than price. Okay, energy number 4, support resistance. So here we have Fibonacci levels, and we drew from this impulse move, from that high to that low. And support resistance, again, helpful by itself, completely useless. Why? Because sometimes the market goes right through a resistance level, like there's your 23.6 level, went right through it. Goes right through it on the way down too. Other times it holds beautifully, like here. Question, how do we know which levels will hold and which the market will just slice right through? Well, that's where, again, Fibonacci or any other support resistance by itself does not help you. It's part of the methodology. It's only 1/5. It gives you a 20% probability, basically. Well, that's not enough. But it is a part of the system. So let's just look at this here for time's sake. So how would we determine that this level has a high probability of holding and the market bouncing off of it, this blue line? Well, first of all, it's a cluster of resistance, that wave high and the 50% retracement level. Number 2, it has a reversal candlestick pattern. Number 3, there's your 50 MA, and it's what? Down. So the direction of this market is still down. Even though price is above it, the 50 MA is angling down, so we're looking for shorts. Timing indicator turns red, turns over. So the time for this market to make a shift has come. Also then look at momentum. When the market's going down, strength. The indicator pulls far away from the zero line. Far away from the zero line. When the market goes up, it barely gets above the zero line. Very little strength going up. To break through resistance, you've got to have some strength. There's not much strength there at all. And then when the market goes back down, again, strength to the downside. So that's how we would put it all together. Now the fractal energy is the fifth and final energy we'll talk about today. And it refers to the next higher time frame. So here we've got the market. This is our left-hand side charts, our setup chart. Market's just kind of meandering right now. It's pretty trendless. 50 MA is pretty flat. It goes from above to below the 50 MA. So okay, we're slightly bearish here. The 50 MA serves as resistance as well. Get an engulfing candlestick pattern, cycle high, momentum's below zero. So all that lines up. But before we can take the trade, we have to look at the next higher time frame. Now, traditionally, people say trade in the direction of trend of the higher time frame. And that's okay, but personally, I prefer to trade in the direction of momentum of the higher time frame. Again, because it's a leading indicator. It's faster. So it's angling down, and because we're going to take a short, that's what we need. And that's the fractal energy. So to put it all together, just to show you how a trade would look, putting it all together, price has been going down for a while, been trending down. Okay, now we pop up above the 50 MA, retrace 50 MA, we're above the 50 MA, now the 50 MA is starting to go up, so we're starting a new trend. I only like to trade in the direction of the trend early in a new trend. So anyway, we've got energy number one, trend is up. All right, so we're looking to potentially buy, but right now it's only a 1 out of 5 score. 2, momentum. Momentum, sure enough, when price goes above the 50 MA, momentum goes above zero. Price retraces, and momentum does a little bit too, but it stays well above the zero line, so it's bullish. So this is a strong trend. So now we have a score of 2. Number 3, when to get in. Well, here's our cycle indicator. Okay, turns down and goes back up. So good, we can get in now as far as timing goes. We've got a score of 3. We need to be buying off of some sort of support level. That red line there, that's your 50% fib line. So that's a good support level. And then number 5, momentum. Now we look over at the next higher time frame, and sure enough, momentum is actually angling up very nicely. Now notice trend 50 MA is down. I don't care about that. All I care about is momentum, and that is screaming up. So that's a 5 out of 5 trade, and I'll take that any day of the week. All right, so let's summarize. All we're doing is we're waiting for the alignment of the 5 energies to put the odds on your side. And my trading methodology is so complicated that it takes a whole sentence to spell it out. So here's your 5 energies in one sentence. We're looking for a trend, number 1, that is strong. That's energy number 2, momentum. Getting in at the right time, waiting for a cycle indicator to give us the timing, with support at your back, support resistance levels. And finally, number 5, confirmed by the bigger scale. That's momentum on the next higher time frame. The method is very robust, very adaptable. I use the same 5 energy method whether I'm trading stocks, commodities, options, currencies, or futures. And by the way, I trade all those markets. It also works whether you're investing, swing trading, or day trading. And again, I do all those time frames. And it's simple. It's objective. We're basically just counting to 5. So here's the, I was going to say offer, but here's my gift, actually is what it is today. And by the way, if you want to write me, Barry@topdogtrading.com is my email address. Feel free to write me with any questions you might have. We don't have time for any Q&A today. We're at the bottom of the half hour, and that's when we have to stop. But if you have any questions, just send me an email there. I'll be happy to respond and correspond with you. The gift I'm giving you today is my free 5-day video correspondence course. What that is each day for the next 5 days you'll receive a video, a trading lesson. And the focus of this is how professionals trade different than amateurs. That is the focus of the trading course. So, in other words, I showed you that thing that a lot of people look at as a reverse head and shoulders. Okay, I actually show you in this trading course why that's not a head and shoulders. I go through the details of why it's not and how to read a proper head and shoulders, what rules have to be met for it to be a real tradable high probability head and shoulders. Same thing with the trend, where I showed you, where to short against or to fade the trend. When do you fade the trend? How do you trade on the opposite side of the retailers? And that's what professionals are doing all the time. How to become one of the 20% instead of the 80%. That's what this whole course is about. So you get 5 videos on that. Each video has an interactive quiz at the end, just to make sure that you got the lessons and the main points. The 4th video also gives you an extra bonus, one of my favorite trade setups. It's called the rubber band trade. And the rubber band trade is a great setup that I take all the time. It is such a high probability setup. It's a very high win-loss ratio trade. So it's more of a scalp type trade, but boy, when it sets up, it just works almost all the time. It's crazy how accurate that trade is. And then, as I said, I will give you my personal cycle indicator, so learning how to time your entries so you don't get stopped out so often. And I'm going to give you that indicator, and not only that, I'm going to give you a tutorial on how to trade it, because just giving you the indicator, frankly, wouldn't do you that much good. There are certain patterns that we trade on it that are super high probability, so that you almost always find the final cycle low and don't get stopped out, or the final cycle high and you don't get stopped out so often. Now that's going to be on a webinar next Tuesday. Again, I got to give you the tutorial, so we're going to do that on a live webinar next, is it Monday or Tuesday? I forget. But anyway, if you go to topdogtrading.com/free, and Reed just did us the favor of typing that into the chat box, so that's a clickable link. Go there, fill out the form for the free video correspondence course, and by doing that, you will also be sent the registration link for that free webinar where I give away the cycle indicator. And by the way, it works on any charting platform. Whatever you have, it'll work. And you get the tutorial and all that stuff. So that's it for me. I gotta get out of here. Our time is up. Thank you very much to Reed and all the good people at Investor Inspiration. You guys are great. Always love your events. Thank you so much for having me a part of this. And also thank you everybody who is attending. And just really appreciate you being here, spending your time with us today, and happy trades.